Hey guys, this is Andre from Wealth Enabler. Hope you're all doing well. In this third and final video about mindsets, we'll talk about mindsets in investing. In the first video, we covered mindsets in our life in general, and in the second video, we extended it toward finances. Now, in this video, we'll be much more specific concerning what we can do with the money we are able to save. And we will also talk about the special kind of investor called a trader. Please take a minute to read our disclaimer, and if you agree with all the terms and conditions, let's go. First, we will start talking about the investor's mindset. An investor here is considered someone who is willing to take long-term investments in order to build wealth. And second, we'll talk about the trader's mindset. Here, traders are concerned about much shorter term gains, and I will particularly talk about a special kind of trader called the day trader. Once we have health finances and we can save a little bit of our salary from month to month, we have to figure out what to do with the amount we save in order to reach our financial goals. And the best thing you can do here is invest your money somehow. The investor mindset should start with matching the time frame and nature of your financial goals to the type of investment. Let's say that you have a short-term investment. For example, within the next 3 to 5 years, you want to buy a new car. In this case, you are probably better off avoiding ownership investment because of the short-term volatility and the high risk involved in such investments. But on the other hand, if your goal is to retire in 50 or 30 years from now, in this case you should definitely consider ownership investments, for example buying stock or real estate, because you will be able to get much higher returns and the short-term volatility will not affect you as much. This topic brings us back to the importance of having short and long-term goals. So once you are set on your goals, try to match their time frame and nature to the type of investment you are willing to take. You have to consider the difference between maturity dates of bonds or debentures and the short-term volatility of the secondary market. You should consider lending investments versus ownership investments, and also risk versus return. High returns always come with high risk, but do not take unnecessary risk. Guys, super important, do your homework. Get to know the kinds of investments you are buying and get to know your options and all the possibilities you can invest in, so you'll be able to make the best choice for you. People usually say that you are what you eat. Have you ever heard this expression? This is used to make people avoid eating fast food. Here, I'll tell you guys this. You are what you read, you are what you listen, and you are what you watch. So make sure you get quality information. Don't lose your time with all these gurus who says they can predict the market or who are trying to sell those miraculous formulas to make you tons of money in the stock market. Don't listen to these people. They are just after your money. Instead, try to find good sources of information. Understand the kind of market you are going into. Understand the investments you are going to buy and their characteristics. Something important that I had to learn the hard way. There is no excuse to lose money out of ignorance. No one will pity you. That's your money and that's on you. So do your best to know what you're doing. Be a friend of compound interest. Remember that future value formula? How the future value changes with the present value, the return rate, and time. So the compound interest here is related to both sign and time. What do I mean by sign? Pay your debts. Do not go into debt unless you know what you're doing. So make sure that your return rate is positive. You're actually investing your money and not having to pay debt. Consumer debt is always bad for us, guys. Do not buy things that we don't need. But sometimes getting a loan to fund your own business or to buy real estate might be a good option and the best opportunity you have to make more money in the long term. So you have to consider your possibilities. And the second variable that will affect the compound interest here is time. So the best time to start investing is 15 years ago. The second best time is today. We cannot change the past, unfortunately. So if you haven't started your investment yet, thinking about your future financial goals, first make sure you have healthy finances and then start investing as soon as possible. But don't rush into investments that you don't know anything about. Remember, do your homework, research, and get to know those investments. And finally, diversify. Have you ever heard that you should not keep all your eggs in the same basket? Because if you do so, you are taking much more risk than you actually need to. Balanced and diversified portfolios will minimize the non-systematic risk. So the more you are able to diversify, for example, real estate and stocks in different sectors, stocks in different countries, the less vulnerable you'll be. And always remember to have some money readily available for emergencies. Create an emergency fund in a very liquid investment such as savings account, checking account, or a money market fund. You never know when something will happen and if you need money for it. So be prepared when the situation arises. Instead of going for a loan, if you have your own emergency fund to cover for those unplanned expenses, you have more peace of mind and you will not have to pay interest on this debt. So win-win, guys. Now I'll talk about the trader's mindset. So a trader can be defined as some individual who engages in the securities market, commodities, stocks, or derivatives, expecting to make a profit. And we have three main groups of traders. So those who use this buy and hold strategy. In this case, these guys are considered more like an investor than a trader because they are looking to build wealth over the long term. They do not care about short-term market fluctuations. The second class is swing traders, and the third class are the day traders. So day traders expect to get financial gains on the short term, and this day trade profit they get is more or less like their paycheck. Day traders will hold their positions for at most one day, maybe some hours or even minutes, and they are all about the short term also. Swing traders are between buy and hold and day traders, so they can hold their trades for one day up to a couple of months or even 1 year. Each kind of category must have their own trading plans and their own strategies to get in and out of their trades. Just so you know, I tried to be a day trader for a couple of months. And it didn't go so well because I'm making videos here to upload on YouTube. But I consider it a very nice experience. And I'm really glad that I took the shot and decided to risk being a day trader because it helped me learn a lot about myself. Now from here to the end of this video, we will focus on day trading, okay? So some people consider it gambling or very similar to gambling. You are just entering your position and the market is completely random. So it doesn't matter your strategy, you might win and you might lose. Some people were able to make millions or even billions from the stock market, while some other people lost all of their life savings and even got into debt because they had no idea what they were doing. So the main idea here, guys, is not to show you those trading setups or indicators or whatnot, but rather to show you guys what you're getting into if you want to try being a day trader. Now, something that goes on in our minds every time we deal with investments, and especially when we are day trading, reason versus emotions. Guys, having an opinion about the market is very easy. You can think that Facebook stocks will go down because of their security issues, or maybe there is this new startup that will be the next Microsoft, and it looks very promising. But once you start putting money on the line, once you start spending money to buy the stocks and you're invested in the market, everything changes. Money has this strange effect on us. It makes us behave as someone we don't even recognize. Now you may say that what move the markets are the politics and economy and what the CEO is doing here and there. But what really move the market are the market participants. And these participants are people like me and you. So human emotions, guys, greed, fear, panic, hope, euphoria, all these emotions have a huge effect in the stock market because money is on the line. And many traders will act on their trades solely based on emotion. And that's bad, guys. I bet you know someone that really annoying, someone that needs to be right all the time. There are people like this in the markets too. They refuse to admit they are wrong and they will hold on to losing positions. This is caused by emotion, by the ego, and is also the trademark of a losing trader. So there is this whole field in psychology and finance called behavioral finance. And they try to study how those emotions I talked about earlier affect our decisions in the market, our decisions when money is on the line, and our decisions when we are dealing with our investments. These are also called trader bias. First, confirmation bias. Look for evidence to support what we believe in, ignoring what does not. People will always try to look for news or articles to support their opinion and will ignore the things that do not support their opinion. This makes us make biased decisions. Always look the big picture, guys. Overconfidence bias. Believe you have a skill or edge other people do not. This might come in handy in some situations in which we are very insecure of ourselves. But in the markets, when we are day trading, we should not be overconfident because this will lead to ruin. Being overconfident every now and then means, for example, forfeiting your trading plan and removing your stops because you are overconfident, because you believe blindly that the price action you are bidding in will happen and you do not protect yourself. And this is one of the factors that people will lose a lot of money. Self-attribution bias, attributing favorable outcomes to own skill and bad outcomes to exogenous facts. So I made a lot of money today. Whoa, look at me, I'm so good. Well, I had a couple of bad trades today and lost some money. Well, it's because the markets were acting weird. Or it's because the American president met with Brazilian president. Or I don't know, it's because it was raining or because we had a full moon yesterday. Do you get the idea? Some people will come up with the most ridiculous excuses to cover up their mistakes. Don't be that guy. Whatever you're right or wrong and this outcome was based on your decisions, own it, guys. Don't be afraid of being wrong. Do not be afraid of being wrong. Being wrong is okay as long as you learn something from it. Causality bias. Believe events are related when they are not. This is something we see all the time, especially in these financial newspapers. They'll try to come up with this good and bad news to explain how the market moves. But sometimes these moves have no correlation whatsoever with said news. Humans like situations who can be explained. We do not like chaos. We do not like unpredictability. So we try our best to explain what we see, even though the arguments we use are wrong. Endowment bias. Highly value something because you own it. So maybe I purchased some stock the other day and I have refused to sell it now, even after this huge sell-off, just because I own it and I think that this has very high value. The price will go up soon. Say that you and your best friend, you both have the same car and exactly in the same conditions. But of course your car is more valuable than his or hers because it's yours. Herding instinct, comfort from following others. In the stock markets, if the price of a stock starts to drop, you can be pretty much sure that this price will drop a little bit more because other people will see the price going down and will also want to sell their stock. This is herding instinct at its best, guys. The same thing can be said, for example, when we want to try a new restaurant. Would you like to go in this restaurant that has a lot of people dining in, or at that other restaurant that has only two customers? Of course, even though we have no information whatsoever about either of the restaurants, we'll be biased to choose the one that has more people because we believe that that one is the best restaurant, even though we have no idea which one is best. Disposition effect or loss aversion. Sell after short price increases and keep losers. So a lot of people in the markets want to be right 100% of the time. And they are really afraid of taking losses because taking a loss means you admit you are wrong. And loss aversion, guys. It was shown in some study that humans are around 2.5% more likely to choose between not losing $5 than earning $5. So this is loss aversion. We don't like to lose. And these are just a few of the biases that might affect the trader and in turn help move the markets. Being emotionless in life is pretty bad, but when it comes to trading, it's your most powerful weapon. Do not give in to emotion and try to keep it rational all the times. As I said before, money changes everything, and when money is on the line, you are more likely than ever to succumb to your emotions. So keep that in mind, guys, and be careful. Now, if you ever considered becoming a day trader, you must have heard about fundamental analysis and technical analysis. This is basically the arguments that people use to buy and sell their stock, unless they really believe that the market is random. So fundamental analysis. This kind of analysis is usually more used by people who are into buy and hold and swing trading. Because first, this is time consuming, and second, this is more complex than the technical analysis. So fundamental analysis can be based on company valuation. For example, discounted cash flow model. This model will tell us, for example, how much a company is worth and if the current market price of the company is too high or too low. If it's too high, we can expect that the stock price will go down. And if it's too low, we can expect the stock price to go up. And if the stock price is too low, this tells us that it's a good moment to buy the stock and profit in the future. Fundamental analysis can also be based on ratios, such as price to earnings or the stock price divided by the company's earnings, return on equity or ROE, and dividend yield, to list a few. Fundamental analysts will compare all these ratios, preferably to 5 to 10 years, see the trends, and use it as a basis to decide whether or not they should invest in said company. And finally, the financial statements. These statements are mandatory for the companies listed in the stock market. So every quarter year or every year, the company must show its investors and the market in general how much they are making, how much they spent on equipment, how much debt they took, or how much debt they were able to pay, how much inventory they have, and so on. Financial statements usually come in 3 different documents. First is the balance sheet. The balance sheet shows what the company owns and owns. It's a picture at a point in time, and it's similar to our mortgage application. The income statement shows how much money the company made throughout a period. So it's like a video between 2 points in time, and it's similar to our tax refund. And the cash flow is the company's cash position. It works like a bridge between the balance sheet and the income statement. To many analysts, the cash flow is the most important document because after all, cash is king and cash is what matters. And a cash flow is similar to our checking account statement. So fundamental analysis will go through all these variables and more, study the company, study the CEO, study the management, and so on, to base their decision on wherever they should buy or sell this company's stock. On the other hand, there is technical analysis. Technical analysis is mostly used by day traders because it's easier. You don't have to read a lot, you don't have to make a lot of calculations. You just have to use some indicators, look at some charts. It's easier than fundamental analysis, but it's still very complicated on its own. The guy responsible for creating the Dow Jones Index is the father of technical analysis. So Charles Dow came up with this trends theory, and he observed that at times the market prices would be going up and at times the market prices would be going down. And this tends to repeat itself in different periods of time, and also this has a fractal nature. So every time the market is in a large uptrend, there will be smaller scale downtrends and uptrends within this large scale trend. And Charles Dow also observed that there are correlations between different indexes and that he could forecast what was going to happen with one index based on what happened in the other index and also the past observations. So based on that, the technical analysis enthusiasts created all kinds of indicators to monitor stock price and volume action as well as market psychology in order to come up with strategies that give us the better setups to buy and sell stock making a profit. A lot of people criticize technical analysis because they believe this is all bogus and this only works because a lot of people believe in it and use it. But nonetheless, many people were able to make some money from technical analysis. And guys, since we don't care about extremes and we are not being paid to advertise one type or the other analysis, we can use both, right? I mean, if you have time, use fundamental analysis to see if that company is doing well financially and has been doing well for the past 5 to 10 years. And use technical analysis to determine what is the best price you should buy their stock in order to maximize your profit. Remember that we should try to stack all odds in our favor when we make investments. There is no guarantee, but we are doing our best to get a favorable result. Also remember that if you don't get the favorable result you are expecting, don't be stubborn and don't be afraid to take a loss in order to save your investment. Sometimes losing a small amount in the stock market is a huge win, and it will be a very valuable lesson for you. You can learn from it and improve your trading plan. Now these important lessons are based on my own trading experience. Remember that my experience is not that huge. I've only day traded for 2 months. I had a couple of profits, had 2 big losses, but I was able to learn many lessons, and this is what I want to share with you guys. In some sense, the markets are a very good psychiatrist because you can't really hide anything from the markets. And you are there completely exposed, buying, selling stock, dealing with your money and all of these emotions that go with it. I got to know myself much better after my trading experience. The markets will humble you. So say you had a couple of successful trades and you start feeling cocky, you start feeling arrogant, and you start to think that this is the right profession for you, this is what you are meant to be, and you'll be able to make a lot of money from it. You start to trade carelessly, risking more than you should. That's your huge mistake. The market will humble you. Boom! After just one trade that goes wrong, you are back to square one, or even square minus 5. Because you have this huge loss because you are not willing to protect yourself and follow your trading plan. That sounds terrible, that is terrible, but this is going to happen. A trading career is like any other career and unlike any other career. So in one hand, you should see a trading career like starting a new business. You need some capital, an initial investment, I would say around 50,000 or so. You need a business plan, a very solid one. You need education, and you need hardware and software and so on. So think about starting a trading career as starting your own business. And on the other hand, trading will punish your tenacity by taking your money. So if you try to be stubborn, if you try to be right all the time, and even if you do your best to prove you're right, it means holding on to losers, you lose the money. So do not use your tenacity to prove you're right all the time. Instead, use your tenacity to learn and educate yourself and to come up with a solid trading plan. If you want to succeed in trading, you need to take risk. That's a given. But taking risk does not mean being stupid. Remember, guys, your money is the fruit of all your hard work. Protect it. Do not take unnecessary risk. And make sure you know what you're doing and that you have a trading plan. Abstract the value of money. In this business, money is just the tool of your trade. From the moment you start thinking about your trading gains as your next travel or your next car or your next house, you are doomed to fail because you're letting emotion taking control of your trades. But if you abstract the value of money and see it just as the tool you need to make your business grow, you'll be much more likely to succeed in the trading business because you are trying to keep your emotions in check. And now let's get back to some suggestions about a trader mindset you can implement if you want to try trading for yourself. Know what you're getting into. Trading does not equal easy money. You have to work hard to learn what trading is, and you have to take risk in order to make some profit. You will not become a billionaire overnight. You will not become a billionaire overnight. If this is what you're expecting, you're going to get disappointed. Have a solid risk and money management plan. Guys, this is very, very important, and this should be the first thing you do before starting your trading career. And write it down so you don't forget. How much risk are you willing to take? How much money are you risking at each trade? What is your risk reward threshold? And so on. The more you can control risk and the more you can avoid taking unnecessary risk, the more money you make from trading. Have a trading plan which includes trading setups you want to take, risk to profit ratio threshold, entry and exit points. A trading plan is very important, guys, because this trading plan will save you from your emotions once your trade is in place. So you will dedicate a lot of time to come up with this trading plan. Maybe you practice on demo accounts for a while, and at some point you realize that this trading plan will make your trading mechanical. This is the best result you can achieve, because once you start the real trading and once money gets into the picture, everything changes. You have that flood of emotion. You start losing money on your trade and you start to get desperate and you want to close this trade as soon as possible. Or maybe you get just a little bit of profits and you also want to close this trade because you want to lock in this profit. And all these emotions are not good for you. Your trading plan will keep your emotions in check. So take time and effort to come up with a solid trading plan. And once you start trading for real, trust it. Have discipline and patience to follow your plans, both the risk and money management plan and the trading plan. So once you open your position, you are no longer reliable. Emotions are likely to take over you and make you do things that you wouldn't normally do. So if you have this trading plan, you know what your target is, you know what your stop loss is, so you don't have to worry about your emotions, okay? There is no room for emotion in trading, guys. And a solid plan will protect yourself from your emotions. Evaluate your trading plan based on trade's profit loss and evaluate your discipline based on how close you followed your trading plan. So once a trade is on, all you have to do is follow your trading plan. But after this trade is closed, please analyze how this trade went based on your trading plan and based on your discipline. How close you follow the trading plan. Keep notes, because by evaluating how your trading plan is working, you can make changes and fit it to your profile, fit it to your trading profile, to the risks you want to take, to the amount of money you have in your trading accounts, and so on. When you are evaluating your trades, try to write down what went on and keep a trading diary. It's almost a given that after you close a trade, you soon forget what happened in it. Maybe you remember the only thing that you shouldn't care too much about, which is how much money you made or lost in that particular trade and what you're going to do with that money. But you should take notes on how this trade went from your trading plan's point of view. Did it follow your trading plan? How did it deviate from that? What was the result and what was your expected result? And also write down how closely you were able to follow your trading plan. Did you panic and close your position ahead of time? Did you execute your plan flawlessly? Keep a diary and read it from time to time. You'll see that you'll be able to learn so much, especially from your losses. And guys, that's it. This concludes our mindset series. Just reviewing what we saw in this video, in the first part, we focused on generic investing mindsets. Planning your investments, considering the time horizons, being a friend of compound interest, and diversifying our portfolio. And in the second part, we focused on a day trader's mindset. We saw a little bit about behavior finance and how those biases affect our emotions while we are trading. Then we saw the difference between fundamental and technical analysis, and we concluded that why not use both? And we ended up with things you should consider before starting your trading career. Hope everything I told you guys made you think about how you see life, what are your mindsets, and what can you do to improve them. Thank you very much for your time and see you soon, guys. Bye bye.